Welcome, everyone. If you're here, it's because you're planning to lead, to manage, to innovate in the business world. And to do any of that successfully, you absolutely have to know how to keep score. Today, we're diving deep into a fundamental accounting process that lets you do just that, the closing process. Now, I want you to forget any idea of dusty old ledgers and boring bookkeeping. This is about strategy. It's about taking a year's worth of financial data and transforming it into the kind of clarity you need to make smart, winning decisions.
So, to really wrap our heads around this, let's start with an analogy that I think will make it all click. Picture your favorite sports team. Imagine they've just had an incredible championship-winning season. The fans are celebrating, they've scored a ton of points, they've lifted the trophy. It was a huge success. But now, fast forward. It's the first game of the very next season. They walk out onto the field. What does that big scoreboard say?
That's right, it says 0-0. Now, at first glance, that seems almost wrong, doesn't it? Why would you want to erase a championship record? Well, think about it. That reset is the most crucial thing that happens. It's what allows you, the team, and the fans to measure performance for the new season and only the new season. It creates a clean slate. It isolates performance into a distinct, measurable period of time. And that very principle, well, that's the whole heart of what we're talking about today in business.
Because that's precisely what every single business has to do. A company's revenues and expenses for a given year, that's the points they scored and the points scored against them during that season. And if you, as a manager, want to know if you're truly winning in the next year, you can't have last year's points still on the board. You have to reset that financial scoreboard to 0. So the big question is, how do companies actually hit this critical reset button? Well, let's dive in.
The formal accounting mechanism for this big reset, this, financial reset button, is a specific set of procedures we call closing entries. This isn't just busy work. This is the sophisticated machinery that makes the critical analysis of one period versus another, one quarter versus the next, this year versus last year, even possible. Okay, so here it is. This is the formal, textbook definition you'll need to know. But let's be very clear. Memorizing these words is not our goal today. It's actually useless without understanding the concepts behind them. Our mission is to really unpack what these terms mean for a decision maker. We've got temporary accounts, that's your scoreboard for this season. We've got a permanent equity account, that's the franchise's all-time history book. And retained earnings, well, that's the specific page in the history book where you write down the final score of each season. We're going to break this all down. To really, and I mean really, get a handle on closing entries, you first have to become an expert on this one fundamental distinction, the difference between temporary and permanent accounts. I can't stress this enough. This is the bedrock of the entire concept. Everything else we discussed today is built right on top of this foundation. So let's bring back our sports analogy. It really is a tale of two different kinds of accounts. Temporary accounts, they tell the story of a single period, a single season. How many points do we score this year? How many goals were scored against us? What was our win-loss record for this season only? Permanent accounts, on the other hand, tell the lifetime story of the franchise. How much cash does the team have in the bank? What's the value of the stadium they own? How many championships are in the trophy case from all the years combined? One is a snapshot, the other is the cumulative history. So let's get specific with these temporary or scoreboard accounts. First, you have your revenues. These are your points, your sales, all the good stuff you brought in during the period. Then you have expenses. Think of this as what it cost you to get those points: salaries, rent, marketing. And finally, you have dividends. Now this one's a bit different. Dividends aren't an expense. Think of them as the championship bonuses paid out to the owners after a successful season. The key thing to see here is that all of these, revenues, expenses, dividends, they only make sense in the context of one single period. So what happens to them at the end? Their fate is to be reset completely to 0.
Now let's contrast that with the permanent or all-time record accounts. These are the accounts that make up your balance sheet. They show the company's overall financial health at a single point in time. We're talking about assets, like the cash in your bank account or the delivery trucks you own. We're talking liabilities, like a business loan you need to pay back. And we're talking equity, specifically retained earnings, which represents the cumulative total of all the profits the company has ever kept. The balances in these accounts are never reset. They carry forward year after year, telling the ongoing story of the business.
Okay, fantastic. So now we know the players on the field, right? We have our temporary accounts and our permanent accounts. So let's get into the playbook. How do we actually, mechanically, execute this closing process? What are the moves?
It's a very systematic 4-step playbook, and it's always done in this order. Step 1. You take all of your revenue accounts with their balances and you close them out to a special temporary holding account called income summary. Think of it like a big mixing bowl. Step 2. You take all of your expense accounts and you pour them into that same mixing bowl. Now, in Step 3, you look inside the bowl. The difference between the revenues and expenses you poured in is your net income or loss for the period. You take that one single number, the result, and transfer it into your permanent history book, retained earnings. And finally, in a separate fourth step, you close out any dividends paid during the year directly against retained earnings as well. It's a clean, logical flow every single time. I really like the phrasing on this slide because it captures the essence perfectly. The goal is to sweep all the activity, all the ups and downs of the period's performance into one single permanent account, retained earnings. By doing this, you accomplish that second, equally important goal. You start the next period with a completely clean slate. You're not deleting the data, not at all. You're archiving it. You're taking the clutter of thousands of transactions and neatly summarizing it into one final number that becomes part of the company's permanent financial story.
All right, so we've talked about the why and the how, but now we get to what I think is the most important part of this whole discussion, the so what. Why do we go through this entire process? This, right here, is where accounting stops being a mechanical chore and becomes powerful business intelligence that you, as a future leader, will use to make critical decisions.
Let's look at the magic happen right here in this table. On the left, before closing, you see the results of the year. The company brought in $500,000 in revenue, and it cost them $300,000 in expenses. Now look at the after-closing column. Poof! Those balances are at zero, ready for next year's scoreboard. But where did that performance go? It didn't just disappear into thin air. Look at the bottom row. The company's retained earnings started at $1 million. The $200,000 net income from this period, the revenues minus the expenses, gets added directly to it. The new balance is now $1.2 million. You see, the season's final score has been officially carved into the all-time record book.
So as a manager, why is this absolutely vital? Let's say you're the VP of marketing. Your CEO comes to you and asks, "Our new digital ad campaign costs a lot of money this quarter. Was it worth it? How did our sales this quarter compare to the same quarter last year before the campaign?" Well, how can you possibly answer that question if last year's sales figures are all jumbled up with this year's? You can't. The closing process creates these clean, distinct, comparable periods. It lets you make legitimate apples-to-apples comparisons, which is the absolute foundation of intelligent business analysis.
And on a bigger scale, when your board of directors or a potential investor sits across the table from you and asks that all-important question, how did the company really do in 2024? You can't just give them a mountain of transaction data. They want the bottom line. The closing process is what finalizes that bottom line. It calculates and crystallizes that single audited figure for net income. That number allows you to say with confidence, we generated $200,000 in profit. That clarity is what drives strategy and gives investors the confidence to back your company's future.
Now, the process, as we've seen, is quite logical, but it's also really easy to make mistakes when you're first learning it. So I want to spend a moment on the most common pitfalls we see students run into so that you can avoid them and make sure your analysis is always sound. By far, the number one mistake is trying to close a permanent account. We see students try to close the cash account to zero, but remember our analogy? Cash is part of the all-time record. You never reset it. Another huge one is treating dividends like an expense. Students will try to close it through the income summary, but dividends aren't a cost of running the business. They are a distribution of the profits you've already made. That's why they get closed directly to retained earnings. And really, all these errors stem from that last point, misunderstanding the purpose. This isn't about deleting data. It's about resetting the scoreboard and updating the history book. If you remember that, you'll avoid these traps.
So I'll leave you with this question to really think about, because how you answer it will define how you see the role of accounting in business. Is this closing process just a tedious, backward-looking chore to end a financial chapter? Or is it a powerful, forward-looking strategic tool that's absolutely essential for preparing to write an even more successful next chapter? The process isn't just an ending. It's the preparation for a new beginning. It provides the clarity and the clean slate you need to make better decisions and build a more successful future for your organization.